80% of business owners are overpaying in their taxes. Don't let this be you this year. Well, what we're gonna cover in today's video are the top 5 tax strategies that we see business owners miss time and time again. And at the end of this video, we are gonna show you that if you put these strategies together over the course of decades, it could save you millions. In our example, $5.7 million. So let's dive into those 5 tax strategies you can implement today as a business owner. If we haven't already met, my name's Luke Turner, co-founder of Moen Private Wealth. We help athletes and entrepreneurs get smarter with their money. We're gonna be putting out more and more content on financial topics just like this. Don't forget to subscribe and follow along as we watch this video. So let's dive into the 5 areas. Okay, so our first tax deduction is our most important tax deduction, which is qualified business income deduction. This deduction could allow you to deduct up to 20% of your overall business income. Now, where do most business owners go wrong? It all starts with how their business is set up. So in order to take qualified business income, you need to be set up in a way that you have distributions from your business. Those distributions from your business are going to get this 20% deduction. So let's look at an example. Let's say you're making $1 million a year. Say $200,000 of that you're paying yourself as salary, and the other $800,000 is profits that get distributed throughout the course of the year. That 20% qualified business income deduction is going to be 20% of that $800,000 distribution figure. Now, the key here is making sure that you have the right salary and the right distribution number in order to ensure that you are maximizing this deduction. If you want to learn specifically about qualified business income deduction, in the description below, you are going to see a blog post where we outline exactly how to calculate and do this math. Number 2 business deduction that we get asked about all the time is, can I write off my brand new Mercedes G-Wagon? Joking a little bit here, most business owners are looking at buying a Yukon or anything over 6,000 pounds because we've all heard about business owners being able to write off vehicles. Well, this deduction is specifically called Section 179. And Section 179 allows us to fully depreciate a vehicle if it is over 6,000 pounds and being used for business purposes. Now, one big caveat that most people don't talk about when it comes to writing off a car is that if we buy a car, let's say for $100,000, that's gonna give us a tax deduction. Just means it reduces the amount of income we have made from, say, $1 million down to $900,000 because we got a deduction. Now, what happens when you resell that car is that you're gonna have to recapture all of that depreciation you took. So let's look at an example. You bought a $100,000 car, you get that $100,000 tax deduction in year 1. But 3 years later, you sell that car for $50,000. You're going to have to recapture that $50,000 in income on your tax return. So still a good strategy to utilize, but remember, you're still spending that money on the car. It's going to depreciate. It is something to be very important to consider. Good strategy to look at, but make sure you're taking into account all of the variables. The number 3 tax deduction that we are always going to look at for business owners is, are we optimizing company retirement plans? I just had a conversation with a business owner just before I shot this YouTube video around the right retirement plan for them. Right now, they're utilizing a traditional 401k plan, and we are looking at potentially optimizing for a solo 401k or defined benefit plan. Now, all those terminologies probably jumble together in your head, so let's break them down. First off, most businesses, they're set up to have what are called traditional 401k plans. And in 2025, we can contribute up to $23,500 into those traditional 401k plans. By contributing money, it allows us to take our business income and reduce it or get a tax deduction for the amount that we put in. But what if I told you that instead of $23,500, we could put in over $300,000 and reduce your income by $300,000? Well, that's exactly the conversation we're having with one of these business owners today. So it's important to make sure that you're optimizing those company retirement plans, because if we optimize them, it could be saving you potentially $10,000, $50,000, $100,000 in tax liability in one given year. Number 4, this is a common question that we get. What is the home office deduction and how can it help me? Well, there are 2 ways to calculate the home office deduction. There's the regular method and there's the simplified method. Let's first look at the simplified method. So the simplified method looks at your house and says that the maximum that you can write off is $5 per square foot up to a maximum of 300 square feet. So this comes out to about $1,500, which is a very minimal amount from a simplified standpoint. But let's look at the regular method. The regular method, the way it looks at it is what percentage of your house is being used for business purposes. Now, let me tell you right now, I've heard some crazy stories about home office deductions. Most of them are deep into the gray and not something that we would ever see a client of ours do. We need to be really careful about the advice that we're getting on home office deductions. It's something that's heavily scrutinized by the IRS, and we need to be very careful and mindful of that. The other important factor as it relates to the regular method is, although it's a percentage of your home, that part of your house needs to be only used for business purposes. This can't be half of my main floor is being used for business purposes because I did a Zoom meeting in my kitchen and I occasionally work in the living room on my laptop. That is not a home office. A home office should be a dedicated area. There should be no kids' toys in there. There should be no Christmas gift wrapping in there. Both of those come top of mind because those things happen in my office on a regular basis throughout the course of the year. So what do we see most people do? Most of the time what we're looking at is honestly the simplified method. It's the way for us to get a deduction without going too far into the gray. Now, for those of you that work exclusively from home and there's a large portion of your house that's being utilized for business use, this is where we dive into that. But we need to make sure that the cost benefit analysis is there, and that is specifically on a case-by-case basis. So that is number 4, the home office deduction. All right, number 5, this is the biggest tax deduction that you will see in the tax code, but it's phasing out, so you need to act quickly. This is what we call bonus depreciation. So bonus depreciation was something that was enacted back in 2021 and is a way for us to take our real estate assets and for us to fully depreciate them in 1 year. Now, you're probably thinking, wow, this sounds amazing. Well, it was amazing back in 2021 and 2022 where you had 100% offset with bonus depreciation. So if you bought $1 million building, you could depreciate 100% of it and reduce your taxes, your income taxes by $1 million. Pretty amazing. Well, this is starting to phase out. So in 2023, that number went from 100% down to 80%. In 2024, it goes down another 20% to 60%. In 2025, it's going to be 40% on down the line. It's very important to make sure that you are staying up to date and engaged around what these tax deductions and tax strategies are, so that way you can be implementing them for your business and for your tax situation. So bonus depreciation, if you own real estate in your business, definitely should be talking to your CPA about that. So now that we have covered those top 5 tax deductions, what is that thing I was talking about earlier where you could potentially save millions of dollars in taxes? Well, let's look at a very quick case study in less than 60 seconds. So if we are looking at this slide, these are tax strategies that we have implemented for clients. And we are looking at these and saying, okay, well, what happens if we implement these over a 30-year time period? So number 1, qualified business income deduction. We talked about this. Potential tax savings of $70,000 per year or $2.1 million over a 30-year time frame. Other tax deductions we've used, $45,500 per year or $1.365 million over a 30-year time period. $35,000 per year saved from retirement contributions or over $1 million saved over the course of 30 years. Tax credits, we didn't touch on these too much, but very important to be looking at these tax credits, potentially saving $27,000 per year or $810,000 over the course of 30 years. And then lastly, avoiding penalties and interest. This is because we are staying on top of our tax planning and our quarterly tax payments, potentially saving you $300,000 in tax savings. So when we look at this example, we are saying that over the course of a 30-year time period, if we are doing tax planning correctly, we're potentially saving $5.7 million in taxes. If you want to look a little bit more at this specific case study, I've included a link in the description below to the blog post that we wrote that's on our website. Check it out. And again, if you have not subscribed to this channel, we're going to be putting out more and more content around financial planning, tax planning, everything you need to be looking at as a business owner. And if you haven't already, subscribe to the channel below.